I wanted to do a video on the current earnings trades that I have. Most of the trading activity this week has been in earnings trades, given that we are in the heart of the reporting season, with several days having over 100 companies that are reporting. So certainly a lot of opportunity presenting itself. Here is a blog post that I did this morning summarizing the current earnings trades and the two positions that I exited this week. So let me get right to it. JCPenney's is a position that I've had the longest. This is from a prior earnings report where I had done what's called a straddle swap, where I am long a straddle out in a future expiration and short a nearer term straddle. The concept here is to continue to sell nearer dated straddle or strangles to continue to reduce the initial cost for owning the January $10 straddle. Domino's Pizza, I'm long stock at $78 with a November 88.5, 85.75 call or put spread. That means I'm short the 85 calls and long the 85.75 put spread. The long stock position was a post-earnings trade. Netflix, I am long stock at $340 and short the January 380 calls. I am long stock from exercising some long calls that I had. In Canadian Pacific, I am long the November 200, 210, 220 call fly and short the 180 puts. That call fly, the middle strike of 210, price is getting near to that, so I will consider putting a buy stop there if it does make a strong move to that level and beyond. But right now it looks good into expiration in 3 weeks. If it can just drift up and sort of settle in that area, that's the sweet spot for a call fly. IBM, I am short the 165 puts that expire next week. In Polaris, I'm long stock at 146.84 with the November 150, 150, 135 call or put spread. Again, you'll notice that's a common thing I do, where I'm short the calls and long a put spread for protection. In O'Reilly, I'm long the November 160, 165 1/2 call ratio and long stock at 165. So essentially, I'm long a 160, 165 call spread, and I'm long stock at 165 and short calls at 165. So at expiration, if price is still above 165, that stock is called away. But I will keep the $5 gain from the call spread. In BCR, I am short the November 150, 145 strangle. I had collected over $6 when I did that trade, and I had a buy stop set at 150, and that triggered. So I am long stock at that level, but that's just a hedge for the short calls. Again, protecting the $6 plus that I collected. In Citrix, I'm short the November 60 puts. That's just a remaining piece from a put ratio that I did for earnings. In NetSuite, I am long the November 95, 100, 105 1/2 call ratio, and I'm long stock at 107.72. Basically, I did that as a tag along, but with the idea that it certainly could become a hedge, and it has. I closed the short 80 puts recently. In Roper, I am short the November 155 and 160 calls, as well as the 140 puts. So I'm short a lot of premium there. The long 150 calls have already been closed. I am long stock at 153 as a hedge, and that is 2 times a size position. In Panera, I had done a look both ways trade, but only the November 170, 165, 161 by 2 split put ratio remains. And I do have a sell short stop set at 160. And that's just to protect the lower end of that put ratio. Right now, that trade is capped at $5. In Facebook, this is another trade where I have a straddle swap. I'm long the December 80 straddle, and I am short the November 14 weekly 76 straddle. And my options net there is right around minus $2. So I only have to sell a strangle or a straddle a couple more times to get my cost to 0 or to a credit. And I would be looking for it to fight back up to that $80 level, which would be a really great spot. At least by November monthly expiration, that would be ideal. An RFMD, I am long the November 12-13 call spread, and that is pretty close to being capped. I had a nice move up into earnings and kept going. In Ruger, I am long the November 47.5, 45, 42.5, 1 by 2 split put ratio. And I'm short stock at $43.65, which is a tag, not really a hedge yet, but getting close to it. And that's a review of the earnings trades.